Most people believe the biggest threat to their money is a market crash, a recession, a red chart flashing across the news. But in 2026, the real danger isn't loud enough to scare you. It doesn't arrive with sirens, emergency broadcasts, or dramatic headlines. It arrives quietly, disguised as convenience, efficiency, and progress. And by the time most people realize what has changed, their options are already gone. Because your money can lose power without being stolen, your savings can be drained without a single transaction ever appearing on a statement. And the final escape hatch people have relied on for centuries, physical cash, is being engineered out of daily life across the world. Sweden is already there. China is already there. The Middle East is accelerating toward it. Europe is openly preparing for it. And once money becomes something you never touch, never withdraw, and never truly control directly, protecting wealth stops being an investing question and becomes a survival question. My name is Blackwell. I am not a financial advisor, but I study financial systems through the long cycles history leaves behind, the ones people usually recognize only when it is far too late. My purpose is simple: to show you what is coming before it becomes unavoidable, and to help you stay financially unbreakable in a world growing more unstable by the day. I do not dramatize the future. I expose its structure. Because once you understand how this system actually works, the anxiety you feel finally makes sense. These pressures are not personal failures. They are signals of a repeating cycle. Let me show you what is happening to your money right now. Most people focus on savings account interest because it is visible. It feels concrete. 4%, 5%. Something you can point to and feel responsible about. What they don't see is the invisible erosion underneath it. Inflation quietly thins purchasing power year after year. Government debt forcing policymakers toward currency debasement instead of honest repayment. Growth slows while obligations expand. And now, layered on top of all of it, the transformation of money itself. Not just how much it is worth, but how it functions, how it moves, and who ultimately controls access to it. Interest rates create a comforting illusion of progress. The balance goes up, the number looks larger, and responsibility feels rewarded. But real wealth is not measured in numbers. It is measured in what those numbers can actually buy. When inflation runs ahead of returns, savings accounts become treadmills that never move forward. Add historic levels of government debt, and the incentive to preserve currency value weakens further, because slow devaluation is politically easier than reform or default. The result is a system where savers appear stable while their purchasing power quietly erodes. And as money becomes more digital and centralized, even the ability to use those savings becomes conditional, turning what once felt safe into something increasingly fragile. Cash is not just a payment method. Cash is autonomy. It is money without permission. It is the final settlement. Once cash disappears from daily life, every transaction becomes mediated by systems, networks, and institutions that can be delayed, restricted, frozen, or monitored. Not necessarily every day, not always maliciously, but it is always possible. And that single fact quietly shifts the balance of power in ways most people never think about until they experience it firsthand. For many people, especially younger generations raised on apps and cards, this shift feels abstract. But for seniors, it can be deeply destabilizing. Cash has always been simple, reliable, and independent of technology. It does not require passwords, smartphones, updates, or customer support lines. When systems move entirely digital, older individuals are often the first to struggle, not because they are irresponsible, but because the system was not built around their realities. Missed payments, locked accounts, and technical errors become barriers to daily life. And in moments of crisis, when digital systems falter, the absence of cash removes the last layer of personal control. What once allowed independence quietly becomes dependency, and that shift carries consequences far beyond convenience. In China, this shift has already happened. Cash still exists legally, but functionally it has vanished from everyday commerce. Mobile payment platforms dominate nearly all transactions, from grocery stores and restaurants to taxis and street vendors. If your phone fails, your payment fails. If your account is flagged, access disappears. Not because of collapse, not because of chaos, but because that is how the system is designed to operate. Money becomes something you access, not something you possess. Sweden followed a similar path. Cash usage collapsed so dramatically that even the central bank now warns citizens to keep physical cash as an emergency backup because digital systems can fail during crises. Europe is moving in the same direction, with digital payments overtaking cash and central banks preparing frameworks for state-issued digital currencies designed to replace physical notes entirely. The Middle East is accelerating toward cashless targets as governments push for fully digital payment ecosystems tied to national identity systems. This is not speculation. It is stated policy direction. Here's where it gets uncomfortable. When money becomes fully digital, ownership matters less than access. You can have wealth on paper and still be unable to function when systems stutter. A cyber incident, a network outage, a payment processor failure, a regulatory freeze, a technical error. These events do not have to be permanent to be devastating. They only need to last long enough to interrupt daily life at the wrong moment. What makes this especially dangerous is how unprepared most people are for even short disruptions. Bills do not pause. Groceries still need to be bought. Transportation still has to be paid for. When access is temporarily cut, even individuals with substantial savings can find themselves stuck, waiting on customer support, approvals, or system restarts. The illusion of wealth collapses the moment money becomes unreachable. History shows that systems rarely fail in dramatic cinematic ways. They fail quietly, through friction, through delay, through restrictions that feel temporary until they aren't. And the people who suffer most are not reckless speculators. They are the responsible savers who trusted that stability meant safety, the ones who followed conventional advice, avoided risk, and assumed the system would always function as promised. Most financial advice completely ignores this reality. It focuses on returns while assuming the rails always work. It assumes access is guaranteed. It assumes money is always usable. But history teaches a harsher lesson. Systems do not only break through collapse, they break through dependency. And the more convenient a system becomes, the more dependent people are on it. That dependency is invisible in good times and painfully obvious when even a small disruption exposes how little control individuals actually have. So the question becomes simple. How do you protect wealth in a world where cash fades, currencies weaken, and access is mediated? The answer is not panic. It is structured. The first pillar is margin, the gap between what you earn and what you spend. This is not motivational advice. It is mechanical. In unstable systems, fragility is punished instantly. People without margin are forced into bad decisions. They liquidate assets at the worst moments. They take debt under pressure. They chase miracles because they have no buffer. Wealthy households operate differently. They engineer surplus into their lives permanently because surplus buys time. Time prevents desperation. Desperation is how people lose everything. The second pillar is ownership of productive assets. Cash, whether physical or digital, is not an asset. It is a claim denominated in a currency pressured by debt and policy. Ownership is different. Productive assets represent participation in real economic output. Businesses adapt to inflation. Revenues rise as prices rise. Ownership adjusts while currency erodes. This is why long-term ownership of productive enterprises has survived every monetary regime shift in modern history. For most people, this does not mean stock picking or constant trading. It means broad, diversified ownership through low-cost index funds held through cycles, not traded through emotions. The third pillar is layered liquidity. In the old world, liquidity meant money in the bank plus cash in hand. In the new world, liquidity must be redundant. Multiple banks, multiple payment rails, multiple access points. One failure should not paralyze your life. And while cash is disappearing from daily commerce, a small physical reserve still matters. Not for speculation, not for hiding, for continuity when systems fail. Even the most cashless nations now quietly acknowledge this reality because digital infrastructure, no matter how advanced, is never invulnerable. The fourth pillar is automation. Humans are terrible at making consistent financial decisions under stress. Fear spreads faster than reason. Trends move faster than discipline. If your plan depends on willpower, it will fail. Automation removes emotion from execution. Automatic transfers, automatic investments, automatic rebuilding of reserves, systems that operate when you are distracted, tired, or afraid. The wealthy do not rely on discipline. They rely on structure. The fifth pillar, and the one most people ignore until it is too late, is payment resilience. In a cashless world, your financial security is inseparable from your digital security. Your email controls your bank. Your phone controls your payments. Your identity controls your access. Weak passwords are a financial risk. Poor security habits are economic fragility. Multiple factor authentication, separate secure email accounts, backup access methods, and awareness of digital threats are no longer technical details. They are survival tools in a system where money exists primarily as data. But there is an even deeper layer to this shift that almost no one is talking about, because it does not feel like a crisis until the moment it becomes one. Cash is the last uncontrollable form of money most people have. Once it fades from daily life, money becomes fully programmable, fully permissioned, and fully dependent on systems outside your control. This is an unprecedented change in human history. For centuries, money was something you could hold, touch, and exchange directly. Today, it is increasingly something you request access to through infrastructure. Why is this happening now? Because multiple incentives are converging at the same time. Governments see cashless systems as easier to manage, easier to monitor, and cheaper to operate. Corporations benefit from faster transactions and richer data. Central banks see new tools for monetary policy in a digital world, and consumers are sold convenience, speed, and simplicity. None of these motives are fictional, but none of them are neutral either. A fully cashless environment also introduces risks that are only now being acknowledged. Financial exclusion for the elderly, the poor, and those without reliable digital access. Vulnerability to outages, cyber attacks, and technical failures. Loss of anonymity in everyday transactions. Increased dependency on centralized systems. Even countries that pushed hardest toward cashlessness are now stepping back slightly, urging citizens to maintain physical cash for emergencies because they recognize the fragility of digital-only systems. This is not about rejecting progress. It is about understanding trade-offs. Convenience always comes with dependency. Efficiency always comes with fragility. And systems that work perfectly in normal times are often the most dangerous when conditions change. So your strategy must evolve. First, broaden your definition of liquidity. Accessible money is not enough. You need usable money under stress. That means anticipating scenarios where digital rails falter. Cyber incidents, system outages, account freezes, regulatory delays. Maintaining multiple payment methods, multiple banking relationships, and a modest physical cash reserve gives you options when others have none. Second, deepen your commitment to productive ownership. In a world where currencies can weaken, shift, or be replaced by digital equivalents, ownership tied to real economic activity remains the most durable store of value. This does not require sophistication. It requires consistency. Third, harden your digital defenses. As money becomes digital by default, your cybersecurity posture becomes a core financial skill. Secure your accounts. Protect your identity. Understand that a single compromised email can cascade into total financial disruption. Fourth, maintain awareness of policy changes without becoming consumed by them. Digital currency frameworks, payment regulations, and financial infrastructure are evolving. You do not need to fear them. You need to adapt calmly and early. Finally, adopt the mindset that defines every generation that successfully navigates transition. The goal is not maximum return. The goal is maximum resilience with acceptable growth. In periods of structural change, chasing the highest yield often creates the greatest fragility. Resilient systems may grow more slowly, but they endure. They preserve optionality. They allow people to respond rather than react. The storm may come quietly. It may come without warning. It may look like inconvenience before it looks like a crisis, a delayed transfer, a frozen account, a system outage that lasts longer than expected. These moments test preparation more than prediction. Those who have built layered systems, buffers, and redundancy do not panic because they do not need immediate perfection from the system to function. They have alternatives. Those who rely entirely on convenience discover its limits the hard way. Convenience removes friction in good times, but it also removes flexibility in bad times. When convenience fails, dependency is exposed. And history shows that the people who survive periods of transition are not the fastest or the boldest, but the ones who quietly prepared for disruption before it felt necessary. So I want you to do something. In the comments, tell me what you are doing to prepare. Are you widening your margin? Diversifying access? Hardening digital security? Building redundancy into how you pay and live? And if you already live in a place where cash has disappeared from daily life, tell others what surprised you the most when it happened. Let me leave you with this. Systems rarely fail all at once. They fail quietly, while most people insist nothing has changed. When you understand the past, the future stops being frightening. It becomes predictable. And remember, the wise prepare quietly, while the unprepared panic for all to see.